So Sabio is, kind of connecting with what Ian said earlier. He looks for high growth companies that are profitable. We are that company. 75% year-to-year growth, EBITDA positive 3 years straight. Last year we delivered $42.3 million in revenue. And we really, once again, I own 49% of the company. Between myself and other insiders, we own 65% of the company. Inside ownership is big. We work with major brands like Amazon, GM, Ford, Toyota, to name a few. We have strong relationships on the ad agencies, and then we have an experienced team across the tech space. In my background, very quickly, I started my career 3 years at Fox, 6 years at NBC Television, another 3 years at AT&T on their mobile advertising business before going into Opera, the browser company, on their mobile advertising business. So that's where my background started. What we're really focused in on is streaming TV. So as you can all imagine, cord cutting, as you've heard, continues to increase. People are not waking up in the morning saying, I need to have cable and I need to have all these different channels on my cable platform. I'm going to instead get connected TV or an app that's going to allow me to do that. And that's really what we play in. For the first time in US history, there are more people who don't have any kind of cable or direct TV than they do have cable or direct TV. So the first time. Just think about that, right? More people now in the US are not paying for cable or linear TV relative to having it. And that is also creating time spent changes. So anyone under the age of 25 is really using their mobile apps on their phones, or they're using apps on their TVs to get their content and stream that content. And that's affecting time spent in traditional TV, which as time spent and the number of people using it decreases, the dollars that are going to move from there into streaming continues to happen. This also creates an interesting dilemma for brands and agencies in the sense that they are also looking for younger audiences. They're not looking, fortunately, for audiences my age or above, I'm 50, or above that. They're looking for younger audiences. And the younger audiences are traditionally on streaming TV and mobile. And that's really where Sabio plays in. In addition to that, you have a very diverse audience base, marketplace in the US, and that continues to grow. And so you have a trend of traditionally diverse audiences that are growing in the US marketplace, but streaming TV as a whole tends to have younger, more diverse audiences. And of course, time spent now, going back to that initial point, time spent on traditional TV is now less than, broadcast TV is less than streaming. So streaming continues to grow. So there's less people watching broadcast than streaming, less people watching cable than streaming. And of course, as attention spans and time spent decrease, and money and eyeballs increase on streaming TV and mobile devices, that's where the dollars are moving into, which is where Sabio comes in.
The world of TV advertising is complicated. Not too long ago, there were only a few television channels people could watch. Running ads were simple because brands knew where to find the eyeballs. But now, traditional TV is becoming a thing of the past. And as people continue to cut the cord, brands know that streaming television and streaming apps are the future. But there are countless streaming apps people can watch, and on more devices than ever before. This makes it hard for brands to connect with the right audiences, on the right devices, on the right streaming apps. Sabio makes this easier. We built a completely unique analytics platform based on audience viewing behavior on mobile devices and streaming TV devices. Brands use this platform to better understand where their target audiences are watching content. This doesn't just help them find eyeballs, but allows brands to advertise to people who would actually want their product. So how does Sabio make money? When a brand pays Sabio to run advertising campaigns, some of those funds are used to run the ads, and Sabio keeps the rest as profit. Sabio helps brands understand their consumers, run effective advertising campaigns, and make the complicated world of advertising simple.
So that's basically what we do. And what makes us unique in the space for a small company our size is we have one of the most complete end-to-end tech stacks in the space. So the first portion of that Sabio portion, is our core business. This is where we work with brands and agencies, the likes of GM, Ford, McDonald's, to connect the dots between what they want to, who they want to reach, and the ability to reach them on streaming platforms. So that's what we do on the Sabio side, and that accounts for a majority of our business. App Science is the insights and analytics tools, and that allows to validate their spend, not only on us, but other competitors. And so for them to understand more clearly, understand ROI. Is it effective? Am I reaching the audiences? And where we're seeing a lot of great traction, specifically on App Science, if you can imagine the US market, when you use Nielsen, for example, Nielsen has a 10,000 panel for Asians, all Asians in the US. I'm of Indian descent. You will have other people who are Korean, other people who are Chinese. They're all grouped into that 10,000 panel size. Our App Science technology allows us to separate and understand user behavior between those groups. Where that comes into play, it's a category that we do well in, is political and advocacy. So as they are trying to understand those audiences, not only brands are trying to understand those audiences, but political advocacy going into the 24 election cycle, that is really resonating with a lot of our folks. And then finally, Vidillion on the bottom side of that equation. We acquired Vidillion about 1.5 years ago, and Vidillion has been a early leader in the streaming space, and they have a lot of technology that allows for not only to help kind of send unused ad spots to other companies that compete with Sabio, but in addition to that, launch apps. So that's what Vidillion plays, to provide us additional technology, additional data that then feeds into App Science, and inventory that feeds into Sabio. So we have a really integrated kind of offering here, and the brands and agencies we're working with continue enjoying that. In fact, we just had a press release we did yesterday that talked about one of these major upfront deals that we just closed that takes advantage of all three components that we bought together. And this is a major agency who has brands like NBA and Viacom, different products that they're offering. And they're initially partnering with us because they want to take benefit. They want to benefit from this integrated system in the streaming and OTT space. And as I mentioned, Sabio portion is all about connecting the brands with agencies with their target audience through the apps on mobile and CTV. Vidillion is the inventory source that we've acquired and allows us to get more inventory and unique inventory supply. And then finally, App Science is analytics. I'm going to spend a couple of minutes on what also makes us unique, going back to the analytics. This analytics is of unique value. This is kind of the crown jewel within our core business. It doesn't account for a lot of revenue, but we see a lot of opportunity there. Roughly about 40%, what's the most recent number? 40% of all brands that we are working with us use some element of this. So 40% of all brands that work at Sabio use some element of App Science to help them reach their target audience. What's also unique about App Science is now App Science as a standalone product is being used by some brands. A major automaker, for example, is using App Science today to help them better understand diverse audiences. And we are expanding that relationship with not only them, but a number of other people. And so that is really, now what makes App Science unique is we take 280 million mobile IDs that flow through our system every month. We connect 110 million streaming devices, cross-reference that to an IP level, push all that data in, and now we're looking at location visitation, app profile data, viewership data on streaming. All of these components combined together provides for a compelling understanding of a consumer. That's 55 million households that we have on this rich data graph. That's 44% of the US households that exist, which is huge. And if you think about it on a sample size basis, once again, Nielsen has 40,000 panel household for all the money flowing through the US. Now, recently they did a deal with Amazon and they're doing some other deals to get more data in, but we have 55 million. And 55 million, that is really kind of nuanced from also a diversity perspective. And these are the brands that we work with. So, we have been working with a lot of these folks for a number of years, including multi-years with GM. And what we're finding is they're saying to us, you're really providing us some unique insights. You're providing us great targeting. And now we're deepening our relationships with these folks and getting, providing some additional capabilities. Business execution. I'm going to have Sajid Premji, our CFO, come up and talk about business execution.
Great, yeah. So as Aziz had articulated, we are not only well positioned to take advantage of the growing opportunity from cord cutting and the move from mobile and traditional TV to CTV, OTT streaming, but we have some great success to date that kind of articulates our successful ability to penetrate this new market. And looking at our growth in 2022, in 2021, we grew our top line sales 75% year over year. And that's after growing our top line sales 84% the year before that. And so in 2022, we had 42.3 million US of sales, up from 24.2 million US of sales in 2021. And on a 12-month basis, we're actually at $44 million US of sales right now. And that's after growing our top line 11% in the second quarter, 16% in the first quarter, for a total cumulative gain of 13% in the first half of this year. And if you kind of compare that to our market capitalization, which is right now at 17 million US, we're trading at a very heavy discount to our top line sales. And and it's been this case for well over a year now, where we've been under 1x. But what's changed in our business now is that our CTV sales on a trailing 12-month basis is now 28 to 29 million US of sales. So now we are trading out for the first time in our history under 1x our CTV OTT streaming sales, and that is probably one of the fastest growing markets in digital advertising. The CTV OTT market is growing at around 21% right now, year over year, and we grew our top line, our CTV OTT streaming sales by 57% in the second quarter, 59% for the first half of the year. So this is our really the bread and butter of our business. It accounted for 62% of our sales mix in the second quarter. And that really is an indication of how fast we've been able to transition from a mobile company to a streaming company. In 2020, we had $1 million of CTV OTT streaming sales on $13 million of sales. Again, as I mentioned, on a 12-month basis, we have over $28 million of CTV OTT streaming sales. And again, trading well under 1x. And we've been able to do that while being profitable. We've been even profitable now for 3 consecutive years, while holding 60% gross margins in the meantime for 3 consecutive years. And what's really also a really positive trend in our picture is really the solidification of our sales mix. In 2021, 55% of our sales were from repeat customers. That grew to 72% in 2022. And for the first half of this year, it's 74% of our sales are from repeat customers. And so that, as you can imagine, the cost of retaining a customer is a lot less than the cost of going after a brand new logo. And that has in turn transitioned itself into a higher average deal size. The average deal size for existing customers tends to be higher than it is for new customers, and that has really propelled a 50% increase in average deal size year over year. And this next slide here is really hammers home the heavy discount that we are trading at, next to our peers. As I kind of mentioned, it actually has decreased the last few days, and we're trading at a market capitalization of $12 million US, and that's again off of $42.3 million of sales last year, $44 million US of sales on a 2012 basis, and $28.1 million US of CTV OTT streaming sales. And that business itself is growing at over 50% in the first half of the year. So if you think about it, the market is telling us right now that our mobile business is worth 0. Our CTV business is worth maybe half X right now. So it really is, we believe, a very compelling discount heading into 2024, which is a political year, and that we are very well positioned to capitalize on. In 2022, it was a record year for our company. We started, making our forays into the political stream, probably late in 2021. We're in a lot better position this year in 2023, going to next year ahead of time. And this next slide here kind of gives you an indication of our current cap structure. It's a very clean cap table. Insiders own 64% of the company, and as Aziz has mentioned, he himself owns 49% of the company. So we are all, very heavily invested in the future success of our business. And right now we have 3 analysts who are covering us: Beacon, A Capital, and Paradigm Capital, and they all have buy ratings in our stock. Yes.
What would you say are the things that investors most underappreciate about your business?
I think that, probably a couple of things. I think number one is maybe just the how fast the transition from cord cutting to CTV is actually occurring in the economy. As Aziz had mentioned, very few people under the age of 25 these days actually subscribe to your basic cable packages, whether it be from Rogers or Shaw in Canada or Comcast, Time Warner in the United States. I think that the pandemic definitely accelerated that trend. And I think that what people are underappreciating is really the growth in the ad-supported stream in that segment. During COVID, we all, as we hunkered down at home, we would have your Hulu subscriptions, your Netflix subscriptions, your HBO Max subscriptions, and people were okay paying that kind of cost for all those platforms because they were at home a lot more. Well, now people are going back to the office. They don't want to pay those same bills because when you add them all together, it's the same cost as you're paying for Rogers or Shaw in Canada or Time Warner in the United States. At the meantime, they still want that content. They don't want to give it up. And so that's where we've seen that ad-supported stream really accelerate. And if you see Netflix, for example, their sales have plateaued, and that's why they introduced that new ad-supported segment, right? We've seen HBO have that for quite some time now. And that really is a feature of streaming, is ad-supported video on demand, and that's where we operate. That's where our bread and butter, and that's where we're able to serve brands like McDonald's and Starbucks to meet these demographics.
But I mean, I was interested in the stock, when it was 80 cents or so about a year ago, and now it's 35 to 40 cents, and the business has grown, but you're losing a lot more money. So what is that from, and how do you get to profitability?
Yeah, and I think that you bring up a good point. I think that when you look at the way that our business has operated on the year-over-year comparables basis, and so in 2022 versus 2021, we were a private company for all of 2021, up till November of the year. 2022 was the first year that we were a public company, and so we did our RTO financing in late 2021, raised about 6 million Canadian, and part of that offering. We used a lot of that growth capital to expand our business and our sales force in the first half of 2022. So when you kind of look at these year-over-year comparables, the full brunt of those costs were felt in the first half of 2023 versus those 2022 comparables were maybe halfway during the quarters when we really started to deploy that kind of capital. And so you're seeing what appears to be a widening loss, which was a widening loss in the first half of this year. But what I will tell you is that what we kind of told the market in our last earnings call is that from the second half of 2022 and onwards, we told the market that the heavy expansion phase in our company was now over, and now it's time to reap the benefits of those investments. And so year over year in 2023, in the third quarter and beyond, we're expecting the year-over-year comparables to be a lot more favorable on the OpEx side of the coin, and that's going to bring down our total losses that you've been seeing, and so we're expecting to get a lot more operating leverage going forward. I think that what we also said on our call at the end of Q2 was that we were seeing a lot of headwinds going into the third quarter, where there's a lot of short-term. I guess it wasn't as transparent as we'd like to see in the market in the third quarter compared to what we're accustomed to seeing. And so faced with those kind of heavy challenges in the short term, we actually underwent quite a significant cost-cutting initiative. And I think that it was an initiative that was overdue. We expanded our company from being a primarily mobile company to CTV in a very short amount of time, right? We had about $1 million of CTV revenue, 13 million in sales in 2020, and now it accounts for over 60% of our sales mix, 28 million on a 24-month basis. And so what does that mean? Well, to run a mobile campaign, the work effort that goes into that is a lot more than the CTV streaming campaign. There's creative involved in that that's not needed as part of the CTV streaming kind of campaigns. And so we kind of did some targeted layoffs to kind of more accelerate, exactly, become a bit more efficient, and recognize our transition to a CTV kind of pure play.
And I think, to Saj's point, one of the things we want to really make clear to the marketplace is we're in a good position. And I think you will see that in Q3 and moving forward. We made some structural changes. So we grew very fast, like Sajid said. Our company went from 55 people to 130 in a matter of essentially a year and a half period of time. And it allowed us to, of course you grow that fast, revenue grows fast. You're not necessarily looking at efficiencies all the time. You're growing, the market's growing, we're taking market share, which we still continue doing. But this situation in terms of the clarity in the marketplace, in terms of spending and the macro situation, has forced us, in a good way, to relook at everything. Our first year of being positive EBITDA was actually COVID year. We fine-tuned our focused, we executed well, actually hit EBITDA positive that year, and then every year for the last 3 years we've done that. This was a similar situation. We grew so fast, we had to step back and say, okay, look, let's now get efficient. And we are now positioned really well going into an election cycle. We believe we're more efficient than we've ever been from a cost basis. And that's really where I think you're going to see this change and this turn where we can grow top of it. Even in Q1 of this year, even though we beat our numbers in Q1 and Q2, what happened in Q1, which was kind of, yes, we had a big loss, but we actually hit positive EBITDA 1 month of Q1 this year. We've never been any positive EBITDA any month in Q1. Because seasonal business, what happens is seasonally we burn a lot of cash Q1, Q2 we burn less cash, Q3 we start making Q4. So that's it. Awesome. Well, thank you for your time, everyone. Appreciate it.
Thank you.